Money is rarely locked by force. It is locked by structure. Modern banking systems do not need to confiscate funds in dramatic fashion to restrict access. They only need to change the conditions under which money moves. And those conditions can shift quietly within legal frameworks through mechanisms designed for stability rather than spectacle. To understand how money becomes locked without appearing seized, it is necessary to examine the underlying architecture of modern finance. By the end of this chapter, the mechanism that allows liquidity to disappear while balances remain visible will be clear, and the historical pattern behind it will no longer seem accidental. The first misconception is ownership. A bank deposit is not a stored asset held in custody. It is a liability of the bank. Legally, when funds are deposited, they become part of the institution's balance sheet. In return, the depositor receives a claim. That claim is honored under normal conditions. Under stress, it is governed by rules. This distinction is technical and therefore often ignored. Yet it is the foundation of everything that follows. Banks operate on fractional reserves. They lend most of what they receive, holding only a fraction in liquid form. This allows credit to expand. It allows economies to grow. It also ensures that not all claims can be satisfied simultaneously. Under normal circumstances, this limitation is irrelevant. Withdrawals are staggered. Payments are predictable. Confidence stabilizes behavior, but confidence is not constant. When banks experience stress, liquidity becomes more valuable than solvency. An institution can appear solvent on paper while lacking immediate cash to meet demands. In such moments, regulators intervene not to protect abstract ownership, but to preserve systemic stability. Stability takes precedence. This is where money becomes functionally locked, not necessarily frozen outright. Rather, access becomes conditional. Withdrawal limits are imposed. Transfer restrictions are activated. Settlement times extend. Clearing systems slow. The balance remains visible. Movement does not. Historically, such measures have been framed as temporary. In many cases they were. In others, the temporary became procedural. What began as emergency policy evolved into normalized control. In 1933, American banks closed nationwide for several days during a banking holiday. The purpose was to prevent panic withdrawals. Depositors did not lose their balances, but they lost immediate access. The closure was brief. The principle endured. In Argentina, during the early 2000s, the crisis restricted bank withdrawals amid currency instability. Accounts were not erased. They were limited. The intention was to preserve the banking system from collapse. The consequence was the same. Money became inaccessible while technically still existing. These events are remembered as crises. Yet the structural mechanism that allows such restrictions remains embedded in modern finance. Deposit insurance reassures confidence, but it does not eliminate liquidity constraints. Central banks provide emergency lending, but they prioritize institutional stability over individual immediacy. The contradiction is quiet but profound. Banks promise daily liquidity while relying on long-term assets. When stress emerges, liquidity must be rationed. The public often assumes that modern digital systems eliminate this risk. After all, transactions occur instantly. Online balances update in real time. Currency feels fluid, but digital speed masks structural rigidity. In fact, digitization can facilitate faster restriction. Controls can be applied centrally, instantaneously, and invisibly. Payment rails can be suspended. Transfers can be delayed algorithmically. The system does not require physical closure to restrict access. It requires only rule modification. The deeper question is not whether banks can lock money. It is under what conditions they must. Debt accumulation provides context. Global debt levels have expanded consistently for decades. Sovereign debt, corporate debt, household debt all have grown faster than underlying productive output in many economies. This expansion has been manageable as long as interest rates remain low and growth persists. But high leverage reduces margin. When debt saturates a system, liquidity sensitivity increases. Small disruptions can cascade through balance sheets rapidly. To prevent systemic failure, authorities may prioritize containment over accessibility. Containment narrows flexibility. In 2008, liquidity froze across interbank markets. Institutions hesitated to lend even overnight funds to one another. The crisis was not immediately about insolvency. It was about trust. Central banks intervened aggressively. Swap lines were opened. Emergency lending facilities expanded. The goal was to restore movement. It worked, but it established precedent. When systems rely on extraordinary intervention to maintain liquidity, they signal fragility. The next time stress emerges, intervention may be expected sooner. Expectations alter behavior. Banks become more reliant on central support. Markets price assets under the assumption of backstops. Risk-taking adjusts accordingly. This deepens systemic interdependence. Interdependence reduces autonomy. As financial systems grow more interconnected, localized stress can propagate rapidly. To prevent contagion, restrictions may be imposed swiftly. These restrictions need not be publicized dramatically. They can appear as compliance measures, temporary suspensions, or capital controls. Capital controls are particularly revealing. When countries experience currency pressure, they sometimes limit cross-border flows to protect reserves. Officially, money remains. Practically, movement narrows. Reserve currencies introduce another layer. When a currency dominates global trade and reserves, its banking system benefits from sustained external demand. This allows higher leverage and larger deficits than would otherwise be possible. Yet dominance breeds complacency. The British pound remained globally central, even as Britain's economic dominance waned. Sterling area arrangements prolonged its relevance. Gradually, however, confidence shifted toward the United States dollar. The transition was not explosive, it was administrative. When reserve diversification accelerates, funding conditions adjust. Borrowing costs fluctuate. Domestic banks, reliant on foreign demand for sovereign debt, face new constraints. Liquidity tightens subtly. Such tightening does not require crisis headlines. It requires only recalibration of flows. Trust erodes before prices reflect it. Depositors rarely withdraw en masse without visible cause. Instead, they diversify. They move a portion of savings into alternative assets. They reduce exposure incrementally. The system absorbs these adjustments quietly, until it cannot. Money becomes locked not when panic erupts, but when options narrow. Consider Cyprus in 2013. Banks faced insolvency due to exposure to Greek debt. Authorities implemented a bail-in. Large depositors absorbed losses. Withdrawals were limited. This was not spontaneous collapse. It was structured containment. The message was subtle. Deposits above certain thresholds were not untouchable. The precedent lingered beyond Cyprus. Modern banking regulations include bail-in provisions. These mechanisms are designed to internalize losses within institutions rather than rely solely on taxpayer bailouts. From a systemic perspective, this enhances resilience. From a depositor's perspective, it redefines security. Money becomes contingent. Contingency rarely feels urgent until activated. Technological evolution compounds this dynamic. Digital banking centralizes oversight. Transactions are traceable. Compliance frameworks integrate across institutions. Financial surveillance increases. These developments are often justified by security concerns. They may indeed improve efficiency and reduce fraud, but they also allow for precise control. When control mechanisms exist, their activation requires only justification. Justification often follows stress. Stress need not be catastrophic. It can be gradual deterioration of liquidity ratios, rising non-performing loans, or currency volatility. Authorities respond preemptively. Preemption feels preventative. It can also feel restrictive. The history of monetary decline shows consistent patterns. In late Roman times, currency debasement preceded visible crisis. Silver content in coins diminished gradually. Trade continued. Taxes were collected. Eventually, confidence weakened sufficiently that barter re-emerged in peripheral regions. Money was not erased. It was devalued. In Weimar Germany, hyperinflation is remembered as the defining event. Yet prior to that, fiscal strain and reparations obligations constrained policy options severely. Currency instability was the endpoint of accumulated imbalance. The recognition of collapse arrived late. In contemporary systems, collapse may not manifest as hyperinflation or immediate default. It may appear as prolonged restriction, gradual erosion of purchasing power, and controlled access to liquidity. The title may declare finality. The structure rarely does. Money is locked structurally when flexibility disappears. Flexibility depends on surplus capital, surplus liquidity, surplus trust. When surplus shrinks, Authorities must choose between preserving institutions and preserving unrestricted access. Historically, institutions are prioritized. This is not necessarily malicious. It is systemic logic. If banks fail outright, payment systems collapse. Credit contracts sharply. Economic activity halts abruptly. To prevent this, temporary restrictions may be justified. Temporary measures have a habit of persisting. The gold standard suspension during World War I was framed as temporary. Convertibility did not return in its original form. The Bretton Woods system ended in 1971. The dollar remained dominant, but its relationship to gold changed permanently. Each adjustment preserved continuity while redefining substance. Modern deposit frameworks may follow similar trajectories. Legal language evolves. Withdrawal thresholds adjust. Compliance requirements expand. None of these changes announce finality. They accumulate. Trust shifts gradually. Selective restriction becomes normalized. Normalization is the quietest phase. In archives of past monetary transitions, historians often note how official communications emphasize stability while underlying shifts redefine trust. The Roman Empire insisted on continuity even as coinage debased. Britain maintained sterling's prestige even as its reserve share declined. Language preserved confidence. Structure shifted beneath it. Today's financial systems are more advanced, more interconnected, and more technologically sophisticated. Yet the principles remain constant. High leverage increases sensitivity. Interdependence amplifies contagion risk. Intervention preserves stability while embedding dependency. Dependency reduces flexibility. Reduced flexibility narrows options. When options narrow sufficiently, money becomes functionally locked, not necessarily confiscated, but constrained. Constrained money behaves differently. It circulates cautiously. It concentrates where trust feels strongest. It fragments across alternatives. Replacement emerges gradually. Alternative settlement networks develop. Digital currencies are proposed. Bilateral trade arrangements bypass traditional rails. These innovations are framed as modernization. They also signal adaptation to constraint. Adaptation implies prior strain. By the time strain is acknowledged publicly, adaptation has already progressed. The finality suggested in dramatic language rarely aligns with structural reality. Money systems do not end with declarations, they transition. Transitions can feel abrupt emotionally. Structurally, they are cumulative. In nearly every historical case, recognition of monetary transformation arrived after key thresholds were crossed. Trust had shifted. Debt had saturated. Flexibility had narrowed. The visible event was confirmation. Money, at its core, is a social contract. When the terms of that contract evolve, balances may remain numerically identical. Their meaning changes. Access becomes conditional. Movement becomes monitored. Ownership becomes interpretive. These shifts do not require panic. They require only structural inevitability. Inevitability is rarely loud. It is procedural. Money has always depended on confidence. Confidence has always eroded gradually. And systems have always adapted before visibly breaking. The perception that it is over often reflects awareness of transformation already underway, not an ending. A redefinition. That pattern has repeated across centuries of monetary history.